Okay, let's jump right in. Welcome to the deep dive. Today we're digging into the Q1 2025 earnings call for Legacy Housing Corporation.
That's right. We've gone through the transcript, and our goal here is to pull out the key takeaways for you. The financials, what management's thinking, their plans, and what they see happening in the market overall.
Basically, everything you need to understand their recent quarter and what they're looking at for the near future. Let's start with just a snapshot of the results, the main numbers.
Yeah, the big headline was definitely net income. It took a pretty big step back, down 32.1% compared to Q1 last year. That landed at $10.3 million.
Okay, 32%. And I assume that hit earnings per share too.
It did. Basic EPS was down 30.6%, came in at 43 cents per share. So yeah, a tougher quarter on the bottom line for sure.
So what drove that? Let's look at the top line, the revenue.
Well, product sales, that's their main business. Selling the houses, that was down about $6.5 million, just over 21%.
21%. And the reason?
Selling fewer homes. Pretty much, yeah. They specifically mentioned lower unit volume shipped across, well, almost everywhere. Mobile home parks, their own retail stores, direct sales. The volume just wasn't there like last year.
But here's something that caught my eye in the numbers. Even though they sold fewer homes, the average revenue per home actually went up by quite a bit, right? Like 23%.
Yeah, exactly. It sounds a bit weird at first, doesn't it? Fewer sales, but higher price per sale.
It does. How do they explain that one?
It all came down to the mix of homes they sold. They shipped fewer of those lower-priced wholesale units, the ones that usually go into mobile home parks in bulk, but they sold a higher proportion of their more expensive retail units directly to consumers.
Okay. So less of the cheap stuff, more of the premium stuff, relatively speaking. That pushed the average price way up.
Precisely. It helped cushion the total revenue drop a bit, but obviously not enough to offset that big volume decline.
Got it. So weaker park sales, stronger relative retail sales drove that average up. What about their other revenue streams? Anything significant there?
Other revenue was down sharply too, by $1.0 million, almost 60%. The main thing there was a big drop in forfeited deposits. Basically, fewer deals fell through where they got to keep the deposit money compared to last year.
Okay, so that's kind of a lumpy item anyway.
Yeah, exactly. Partially offset by small bumps in portfolio fees, service revenue, and a little bit from land sales.
And they have those big loan portfolios too for consumers and parks. How did they perform?
The interest income from those was actually flat year over year, but the portfolios themselves kept growing. The consumer loan book increased by about $20 million, and the mobile home park portfolio also grew by around $20 million.
So lending is still growing, anything decrease?
Yeah, the dealer finance notes, that part went down by about $2.4 million.
Okay, so summing up the snapshot, volume down, especially parks, hitting revenue and profit, but a higher average selling price due to the mix shift. Now let's dive deeper. Beyond the headlines, into costs, margins, management's take, and the outlook.
Right, so costs. Cost of product sales went down, which makes sense, right? You sell fewer homes, your cost to build those specific homes goes down. But the profitability per home, the gross margin on product sales, that actually squeezed. It fell from 33.6% last year to 29.2% this quarter.
Ooh, okay. Margins tightened. Why would that happen if they were selling more of those higher-priced retail units you mentioned?
Yeah, that's a really important point they addressed later on the call. They kind of suggested Q1 was probably the low point for margins. They mentioned being underabsorbed on labor. Basically, their factories weren't running full tilt because of the lower volume.
So fixed costs like factory overhead and maybe some labor got spread over fewer units, making each one cost more from that perspective.
Exactly. Plus, they said price increases they'd put through hadn't fully kicked in yet for Q1 sales, and they've got another one planned for mid-June. They seem to think around 30% gross margin going forward was more realistic.
So sounds like some internal production inefficiency maybe, linked to that lower volume, hitting the margins along with timing on price hikes. What about SG&A, the operating costs?
Selling, general, and administrative costs. They ticked up a little bit, about $0.4 million, or almost 7%, mostly driven by higher legal costs, a bit more set aside for potential loan losses, and some other miscellaneous stuff.
But offset slightly elsewhere?
Yeah, offset a bit by lower warranty costs, payroll, and professional fees. So a slight increase overall there.
And that other income line that dropped off?
Right. The big piece of that drop was related to some non-operating interest income they got last year from a settlement. It wasn't part of the core operations, so that comparison makes this year look lower.
Okay, let's shift gears to the balance sheet. How are they looking on cash and debt?
Pretty solid, actually. Cash increased during the quarter, ending at $3.4 million, up from $1.1 million at the start of the year. And crucially, they had zero balance drawn on the revolving credit line. So decent cash, no revolver debt.
That's good financial health. And book value, still growing.
Yep. Book value per basic share kept climbing, up 13.1% year over year to $20.87.
Okay. So the financials show the volume challenge, the margin pressure, but also that mix shift helping the average price and a solid balance sheet. What did management actually say about that Q1 volume being lower than they wanted?
They definitely acknowledged it, said it was lower than desired, and they spent time really digging into why, even went to a big industry trade show, MHI, to get more perspective.
And what are they doing about it? What concrete steps are they taking to get sales growing again? They lay out a few things, right?
Yes, absolutely.
Yeah.
This seems like a key focus area. First up, simplifying their product line. They basically said they'd added too much complexity over time, too many floor plans, colors, options.
Yeah, that can happen. It bogs down production.
Exactly. So they're cutting back significantly based on sales data. Fewer choices, simpler pricing. The idea is to focus the factories on their core high-volume products and just get more efficient. Sounds like a big operational shift.
Makes sense. Less complexity equals faster production, hopefully. What else?
Second, they're tweaking their mobile home park financing program. Historically, it was mostly geared towards park owners buying homes to rent out.
Okay.
But they're seeing more demand now, especially in places like Texas, from park owners who want to sell homes to residents within their parks. A different model.
Facilitating resident ownership instead of just rentals.
Right. So they're modifying their program to accommodate that model better under certain conditions. They think this could open up a new group of park customers who prefer that strategy. It shows they're trying to adapt.
Okay. Adapting the financing. And the third major initiative.
People and focus. They're having senior management spend more direct time on sales, marketing, and their land development projects. And they've hired some experienced folks in the industry for key spots, a new GM for their Fort Worth plant, directors of engineering and purchasing, and a Texas regional manager just for their own retail stores.
Putting firepower where they need it. So hiring veterans, focusing leadership. Are these changes showing any early signs of working, like in current production?
They did give a little hint there. They said production in their Texas plants is currently running higher than it was in Q1. They mentioned working hard to ship those houses out and build up the order backlog again. So maybe starting to gain some traction, at least in Texas production.
That's encouraging. What about their view on the broader market for the rest of 2025? Still optimistic?
Generally, yes. They acknowledged the sort of background noise of uncertainty and potential tariff impacts, but they maintained a positive outlook overall. They said their independent dealers are mostly doing okay, though they did note South Texas dealers had a definite slowdown in Q1, maybe related to post-election stuff they thought, but that seems to be bouncing back now.
Okay. Dealers mostly healthy, but what really jumped out was the difference between parks being weak and retail seemingly being strong, right?
Absolutely. They were pretty bullish on their own company-owned retail stores.
Yeah.
Get this. April unit sales were the highest in 3 years, and May was apparently tracking just as strong.
Wow. Highest in 3 years. That's a big data point.
Yeah, and they pointed to retail financing as a key leading indicator, retail loan originations. In April alone, they hit the highest single-month total since the company went public.
Highest ever in 1 month.
Yep. And year-to-date through April, those originations are up 51% compared to the same period last year.
51%. Okay, that is a massive jump. That definitely signals strong demand on the retail side.
It really does.
So how do they explain that retail strength versus the weakness they saw in the community shipments, the park side, in Q1?
They chalked up the park weakness mostly to general market uncertainty, making some park owners hesitate on big investments, and also just timing issues, specific large projects or orders getting delayed or pushed into later quarters. They call that segment lumpier, less predictable flow.
Yeah.
Mentioned delays in Georgia and Texas specifically.
Okay, so park owners being cautious plus specific project timing makes sense. And they went to that MHI conference. What was the vibe from the industry overall?
Feedback seemed pretty decent. Park owners apparently said demand for rentals is still solid in most places. M&A activity in the park space is picking up too. And management sounded hopeful about potential regulatory changes coming down the pike.
Like what?
Things like maybe easing up restrictive local zoning for manufactured homes, better access to government financing options, updates to the HUD code, stuff that could really help the whole industry long term if it actually happens.
Yeah, regulatory tailwinds could be huge.
Yeah.
What about the health of their current loan book? Any concerns there?
Nope, sounded good. They said delinquencies across their consumer and park portfolios are still low. And when defaults do happen, their recovery rates remain strong. So credit quality looks solid.
Good to hear. And quickly, that big land development project near Austin in Bastrop County. Any updates?
No big land sales in Q1, but they still plan to sell off some non-core land throughout the year. For Bastrop, that huge 1,100 pad project, Phase 1 roads and utilities are done. They expect to start selling those Phase 1 lots this summer.
Selling lots this summer, okay.
And Phase 2, which is planned as a rental community within the development, is also underway. Roads, water treatment, plant construction. It's moving.
Yeah.
They made a point of mentioning the really high lot rents in that Austin area market, over $1,000 a month.
Wow.
Yeah, really underscores why they think that property holds significant long-term value once it's fully built out and operating.
Okay, Bastrop is moving along. Let's hit some highlights from the Q&A section of the call. Pricing came up again.
Yeah, they confirmed the main driver for that higher average selling price in Q1 was definitely the mix shift, less park wholesale, more retail. They mentioned the February price increase again, and the one planned for mid-June. Interestingly, they also said the recent tariff news didn't impact that planned June increase as much as they initially worried it might.
Okay. And the MHP, the park sales weakness, just less demand overall or more specific issues?
They said it was a bit of both. Some pockets of weaker demand, yes, but also those timing delays and pushed orders they talked about in Georgia, Texas, and with a northern partner. And they tied it back to modifying their MHP program again, trying to capture those park owners who now want to sell homes to tenants, not just rent them, adapting to that shift.
Got it. What about capital spending plans? Anything major beyond Bastrop?
Nothing out of the ordinary, they said. Finishing Bastrop is the main focus. But they're always looking, opportunities to add dealers, grows the loan book, maybe even add manufacturing capacity if needed, and they confirmed they're actively working on selling off that non-core real estate.
Okay. How are they feeling about production rates and orders now in Q2 compared to that slow Q1?
They expect Q2 to be better. Acknowledged Q1 is seasonally slower anyway. Sounded really positive about the retail side, both dealers and their own stores, pointing to those strong loan originations again.
Right, the 51% jump.
Exactly. Park side is still described as slower, lumpier, because of those order delays. But they think simplifying the products will really help production pick up, especially in Texas, where they apparently have the orders waiting. Georgia's plan is more focused on rebuilding its dealer network right now.
So expectation is Texas Q2 production up from Q1?
That's the message, yeah.
And margins again, any more color on expectations for Q2 and beyond?
Just reiterating that Q1 was likely the low point because of being underabsorbed on labor and the timing of price hikes.
Mm-hmm.
That 30% gross margin target seems to be what they're aiming for going forward.
Okay. Tariffs and general uncertainty, how big a deal is that for them?
Their take was interesting. They said tariffs themselves aren't a huge direct hit for Legacy compared to maybe others because they build domestically, source most materials domestically. The bigger issue, they feel, is the uncertainty it all creates. Makes businesses like park owners hesitant to commit to big investments or orders.
So it's more the indirect effect on confidence.
Exactly. They basically said a return to some kind of economic normalcy would be good for everyone in the industry.
Makes sense. Last Q&A point, someone asked about a competitor, Skyline Champion, reporting strong shipments when Legacy's Q1 was soft. How did they explain that difference?
They pointed to Legacy-specific factors for their own Q1 softness. Things like those shipment delays we discussed, their choice to hold the line on pricing even if it meant less volume temporarily, the product complexity they're now fixing, and having new sales team members getting up to speed.
So basically saying, our Q1 issues were mostly internal or timing related, not necessarily reflecting the whole industry.
That was the strong implication, yes. They finished by saying they still firmly believe in the industry's fundamentals, the need for affordable housing is massive, and potential regulatory relief could be a big help.
Okay, great summary of the Q&A. So let's try to wrap this all up. What's the big picture here from this deep dive into Legacy's Q1 call?
Well, Q1 was undeniably tough on volume, especially in parks, which hit the top and bottom lines and squeezed margins a bit. But that shift towards higher-priced retail units did boost the average selling price, which was a positive offset.
And management seems very focused on fixing things internally, right?
Absolutely. Simplifying products for efficiency, tweaking the MHP program to match current demand, bringing in experienced hires and focusing senior leadership time.
Plus, those green shoots in April and May retail sales, and especially the loan originations, look promising.
Definitely positive signs there. And that big Bastrop project keeps moving forward, representing potential future value. Management clearly still believes in the long-term story for manufactured housing.
It really paints a picture of a company trying to navigate a choppy market by focusing hard on what they can control internally and adapting where needed.
Yeah, that seems like a fair assessment.
Which leads us to our final thought for you, the listener, to chew on. Considering how much Legacy is emphasizing these internal fixes, product simplification, adapting financing, the strength in their own retail stores and loan activity, how much do you think their future success hinges on just executing that specific internal strategy? Well, maybe even more so than just riding the general wave of the broader housing market.
Yeah, that's a really interesting question. How much is internal execution versus market tailwinds? Something to watch.